Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. It is Monday morning, April 3rd, and this is The Talking Point. Thank you for joining me on this call. There's quite a bit to report, even though we thought it would probably be a kind of quiet Monday morning before the payroll report comes out at the end of the week. But you had a report from OPEC. It's important. They have decided to cut production, and it's a larger cut. Obviously, that's why it's making news, than the cut that they announced last September. So let's go into this and see why it matters from a number of different perspectives. First off, you may recall that last summer in July, President Biden was in Saudi Arabia, hoping to discuss Middle East affairs, but also trying to get the Saudis to increase production, because you may recall that gasoline prices were very high, and the president and his team wanted to see if they could have some cooperation from Saudi Arabia. They are the largest producer of oil. They are the de facto head of the cartel, OPEC Plus. In any event, it didn't work. And what we got instead in September of 2022 was a cut in production. It was pretty modest. That cut in production was to begin in October and was to last throughout this year until November. Again, it was fairly modest. However, the point I want to make is that OPEC has made it very clear over the last number of months that they want to protect the prices. And they say they want to, stabilize the market, follow the market. But we know that they want to keep a lid under the prices. So in any event, when you had Russia just recently announcing they would cut by 500,000 barrels of oil a day, they then joined in and said, we're going to do the same thing. And in total, it comes to about 1.6 million barrels a day, given Russia and given the rest of OPEC joining in, with the Saudis saying or pledging the largest cut. What this has done is it pushed up oil prices. Now, keep in mind, any disruption of supply, whether it is a price cut, whether it is a hurricane, the kinds of hurricanes that basically cut production, whether it is a strike where workers go on strike, that feeds the oil price disruption of supply. But when you have an actual production cut, that is kind of the best cut you could have in order to raise prices. So that's what they're doing. Now, why now? The reason is, when you look at it, is fairly simple. I don't know why the headlines they were shocked. Everyone is surprised. They were shocked. I think folks who follow the energy markets were just waiting for this to happen, because the notion of recession hit, and not just, the recession talk or soft landing, hard landing, but because of the bank crisis, the concerns have been that lending would be curtailed by banks to small business owners and to consumers. So when lending is curtailed, if that is in fact what happens, it hurts the overall economy. In addition to that, expectations are that with the Fed continuing to raise rates, expectations right now call for perhaps one more rate hike this year, maybe even two more, that it is going to tighten financial conditions more. The banking situation did tighten financial conditions. You could see it in the report from the Chicago Federal Reserve Bank that every week comes out with the financial conditions in the U.S. They look at 105 different measures. They are looking at liquidity, risk, and leverage. And we saw a period in which financial conditions were actually pretty loose, and we saw the market reacting accordingly. When financial conditions do tighten, it becomes more difficult for markets to just keep going higher and higher without fundamentals underpinning the move higher. So in any event, the oil prices, as you saw, whether it is U.S., West Texas Intermediate crude, or Brent, which is the global benchmark, prices coming down and coming down quite dramatically, actually, as the fear that really a recession is going to hit and that it could be deeper than the market initially expected. So what they did was they came in and said, yes, we're cutting production. Now, just over, I want to say 5 weeks ago or so, the Saudi energy minister made a comment and said, hey, wait a minute. We're sticking to the target we have. And by the way, that was the target with the production cut that came announced last October. And he said, we're staying with that. We're not changing it. And then he added, period, sort of end of discussion. However, following that comment came, again, the banking crisis, if you want to call it that, concerns over higher interest rates, the cost of capital going up, and also, above all else, more and more concerns that the economy is going to slow down markedly. And what happens is the expectations then for oil demand go down. Now, you may come back and say, well, Quincy, what about China? Wasn't that supposed to push oil demand up and up dramatically? The answer is yes. When China announced the end of the COVID restrictions, what we saw was oil prices actually did climb higher. But the reopening was not without problems, because what happened was folks started traveling in and out of China for the lunar holiday, and COVID actually hit dramatically. So the notion that oil demand would pick up as air travel picked up quite dramatically, and China was allowing planes to come in and also to leave, it didn't match what the market had thought. And that the demand coming out of China, which, by the way, is the world's largest importer of oil, was pushed closer to the second half of the year. So the energy market did not get that catalyst that it was looking for if China's demand went up right away. China had been importing oil from Russia, by the way, but again, not as much as the market had initially expected. So they came in what has been dubbed, and not just recently dubbed, but actually going back, dubbed the put. You ever hear of the Federal Reserve put? In other words, when the market goes crazy and it's going down, the Fed comes in and either says something to loosen conditions or actually lowers rates. That was been called the Fed put. Well, we have what we call the OPEC plus put on oil. So they came in and said, hey, this is what we're doing. We want to stabilize the market. We want to make sure the market remains efficient, and so on. Now, here's something interesting. Going back last October, remember that follows the announcement in September that they were going to cut production, but actually it was fairly modest. The Nigerian oil minister made a comment when he was speaking with a group. It was picked up, and he said, look, the OPEC wants to keep oil at $90 a barrel. They'll do that. $90 a barrel is where we want to be. That's what the market had expected, that's the price they want to defend. Let's go over this for 1 minute. The OPEC understands that they are in a sweet spot right now. This transition to clean energy, green energy, is going to take time. And the world needs stable, reliable crude oil until they get to that point that they are projecting, where most of it will be, again, clean energy. So they understand that, but they also understand it's finite. At some point, their so-called liquid gold loses value, and they want to make the most of it now. You know that in Saudi Arabia, they're spending trillions of dollars on reshaping their economy, wanting to have it be a tourist spot, an area where global logistics is a focus, and also, other businesses outside of the oil market. This is important for them as it is for the other large producers within OPEC. And so They want to make sure they can make the most of it and make the most of it now. So however you want to call it, that they're protecting, the energy production, or they're being greedy, however you want to call it, it is what it is, as they say. Now, just think for one moment. It may not be completely always the cuts that they have 1.6 million barrels a day. If oil demand picks up and picks up dramatically, they can actually change that. Similarly, they can make it actually tighter if they wanted to. But this gives them flexibility, watching and monitoring the demand, especially as the U.S. goes into the driving season, for example. But nonetheless, you're going to see gasoline prices climb. The next issue is, what does it do for the Federal Reserve? Because remember, even though oil comes up in the headline for inflation, and the Fed watches core. Remember, oil is up there with food and energy. They still watch it. And the question is, does it lead to higher inflationary expectations? And that is key. Keep in mind that the University of Michigan Consumer Sentiment Report that comes out on Fridays has a part of that report that looks at consumer expectations for inflation for the near future. And when oil prices, gasoline prices were quite high, those expectations climbed high with it. And then when oil prices and gasoline prices came down, when the Biden administration decided to take oil out of the Strategic Petroleum Reserve and have it refined and essentially trying to lower gasoline prices, which they did manage to do, all of a sudden, what you saw was expectations for future inflation coming down. The Fed does not want to see expectations climbing higher, because if that were to happen on a steady basis, it becomes entrenched in the psychology of inflation. And that is something the Fed definitely, no central bank wants that, because what it means is everyone expects prices just to keep going up, up, up. You start seeing hoarding, and if it continues. So this is important for the Fed as well. If prices continue to rise in gasoline, people are going to cut their spending on other things. That's the way that it typically works out. And it is pressure on the average U.S. wage earner. There's no doubt about that. And we saw that during the initial period after the conflict began between Ukraine and Russia, where gasoline prices just about skyrocketed, a concern amongst the U.S. consumer about how far can this go. So in any event, that's where we are this morning. The energy sector, which led the market higher last year, has been reduced this year on expectations that oil prices were coming down, and the energy sector estimates were cut. We'll see how that changes as the market discusses whether or not this price cuts are going, or production cuts are going to hold during the course of the year. So in any event, we have more to do this week. Last week, was an interesting week for the market too. But everything was focused really on this week, and this week, not counting OPEC, by the way, but in terms of the labor market. And the reason for that is that the wages are still a concern. They're still high, although it seems as though the climb higher has been stalled, and we will find out on Friday whether or not wages stay in that level where it seems to be pulling back. It's crucial for the Fed, and the reason, I'll say it again, is that wages are an important input cost, just like anything else. That most companies, by the way, in this country, pay wages more than anything else that they pay. When that happens, they try to pass it along to the end buyer, whether it's the consumer, retail, or corporate, or business, and so on. But when you're in an environment the way we are now, where there seems to be, as we saw from the durable goods numbers that came out, the core part of durable goods showed that capital expenditures are easing a bit rather than climbing higher. So again, we're seeing a little bit of downward shift in terms of spending by corporations. Will they pay extra for higher prices? The chances are not. So this is an issue that we have to face in terms of the wages. Again, on Friday, we'll have a sense of whether or not we're seeing it come back down from the last report. We will also look, in addition to hourly wages, that's one, but also how many hours are worked per week. And why is this important? It's important because if the hours per week are down, even just a bit at the margin, it will suggest that the economy is slowing. Very logical, because when we add hours to the week, it's clear that companies need workers working longer, that the economy is doing better. We'll also see, which areas are hiring. It's been hospitality. It's been, the consumer side of things, certainly not in manufacturing. So this is important. This is the big event this week. We'll keep our eye on it. The ADP report that comes out midweek, yes, it's important, but we know that is just private sector hiring, and it does not have necessarily a direct positive correlation with the Friday number, which includes governments. And yet we follow it for the trajectory. So if it's way higher, suddenly, you'll start hearing a whisper that maybe the number for Friday will be higher than expectations. Right now, today, Monday morning, the median expectations for Friday is 235,000 new jobs added. So it's an important week because, again, the market is trying to figure out if we get another rate hike in the May meeting of the Federal Reserve. Now, also today, before I came on this call, the Institute for Supply Management came out with a report on manufacturing. The news was not good. Manufacturing is below the 50 level. Remember what 50 means. Above 50, it means we're in expansion territory. Below 50, it means contraction. It has come down below 50. It's been below 50 for some time now, but it is below the market consensus for today's report. In addition, the prices paid component, again, very important, actually came in lower than expectations, which you'd have to say is good news. And the orders, we always look for new orders, and that is down. So we know manufacturing has been hurting. We wanted to see it at least bottom. There will be more reports coming out, on the regional side, and we could then piece together what the monthly number will be. But right now, we're also waiting for the Institute for Supply Management. Remember, this is an important purchasing manager's report. That's what this constitutes. And we will see the service sector report coming out midweek. And remember, that's the largest portion of our economy. We will be looking for new orders, hiring expectations, prices paid, and so on. That has actually started to turn the corner higher. So we want to see where that hits. This week also, we're watching, obviously, the banks and seeing whether or not the banks can continue to be underpinned by, one, less fear, that's one, and whether or not we'll see more news on private sector banks. When I say private sector, they're public banks, but in the private sector, not government, coming in and saying they want to buy, for example, parts of First Republic. Silicon Valley Bank, again, sees a bank that's based actually not out west, but in Raleigh, North Carolina, going in First Citizens Bank, buying a good portion of that bank. So that's good news when you start to see a bank that is a healthy bank wanting to buy a bank that has been under tremendous pressure. So again, a lot for the market to digest this week, but all focus will be on Friday's report. The market would be happy with not a collapse in the employment landscape, but certainly to see a slowing in the landscape. And why? Because we know the Federal Reserve wants to see that. and because they want to see demand, overall demand on the consumer side come down. And the overall demand on the consumer side has been resilient because the labor market has remained incredibly strong. So it's a bizarre situation we find ourselves in, right? Where in order to bring inflation down, we have to slow what has been a very strong economy. Not kill it, but just slow it. So we will be back next week, but we will be watching very closely the commentary on the energy sector, and also, again, the reflections of what the market sees the Fed's job now, with oil prices climbing higher, something they do not want to see, and how the market sees the Fed is going to have to deal with this. So an interesting week for sure. Thank you so much for joining me. Have a very good week. Thank you.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.